It's really been an outstanding year so far for stocks. Looks like we've got great performance out almost every segment of the market here. And the reason that we have this great performance is because earnings have grown roughly 20% over the last year. A little stock 101, remember that stock prices are a function of future earnings. And so that's why we have these great returns. We've had great earnings. Okay, now what you see here are year-to-date returns for the 11 economic sectors of the S&P 500. Real estate bouncing out of that low we saw back in June of 2020 because of the pandemic. Communication services here, this is the sector that holds Google and Facebook and Netflix. All those companies have done very well. Financials have done well. There's a bunch of banks in there. As interest rates rise, banks do better, they earn more. So financials have done well. Energy has done well because, again, remember where we were a year ago. It's bounced off that bottom. Tech seems like it's always going to be a winner. Why? Because there's so many growth opportunities in that sector. This is the largest sector that's represented in the Tandem portfolio. Okay, what I did here was I took the S&P 500 and I sorted it by the top contributors to the index, okay? So I did this yesterday. Yesterday, the S&P 500 for the year was up 20.79%. So I sorted this, and you can see here I took the top 20 names in the index, and they account for 9.65% of that 20% return. So that's 46% of the S&P 500 comes from just these 20 names here. I'm going to pull up Microsoft, and I'm going to show you their earnings, and you can see how much they grew. Here's 2020. This is EPS, earnings per share. Here's the 4 quarters, and you can see the change here. It's a 20% change. And then from 20 to 2021, you get a 38% change. Now, that's pretty amazing. This is what we call non-farm payrolls. Right now, the labor force is made up of 147 million individuals. This is pre-pandemic. You can see here we were at 153 million strong. Here's the pandemic, and you can see we rebounded pretty quickly. That's pretty amazing recovery there from a complete standstill. And now we're about, let's call it 6 million short of pre-pandemic. And I guess the point I want to make is that some of these jobs might not come back. We've talked about creative destruction and how this pandemic eliminated some jobs, how companies during the pandemic were forced to get more productive and do more than less. They become more profitable. Companies have become more profitable, more productive, but the flip side of that is that people lose jobs. And we think that, that is why the Fed policy has been so accommodating for so long, because it's going to take time for these people to retool and find their place in the economy and become productive again. And, some economists and some market participants, they'll argue that the Fed is too accommodating. They're creating inflation. They're creating asset bubbles, and they are, but they're also trying to pull more people into the labor force. And the reason that this is so important is because our potential GDP, the potential growth of our economy, is a function of labor. It's a function of labor and productivity. Growth in the labor force times productivity equals potential GDP. I wanted to touch a little bit on inflation here because that has been a hot topic and it's important to everybody's wallet. These last 2 lines here indicated with this green shading here on the side. And this shows me my last couple weeks of data. Blue indicates a cooling and orange indicates a heating up. These are investor expectations for inflation. This is a 2-year expectation, and this is a 10-year expectation. You can see here we've heated up here, and investors expect inflation to be roughly 2.65% over the next 2 years. Now, if we go up to this next line here, this is a 10-year expectation, and you can see that it's lower. So what does that tell you? It tells you that this inflation expectation, it is not embedded. If it was embedded on a long-term basis, our 10-year expectation would be higher than our 2-year expectation. Our employment cost index back 2 cycles ago was near 4%. So we've never gotten that high again. All this inflation, we've just felt deflationary force, nothing but deflationary forces for the past 40 years. So a little bit of give back. Again, this is a function of the Fed wanting to pull more people into the labor force. And so again, they're going to allow inflation to run for a little bit. They do not think it's embedded. Time will tell. Inflation is, it's creepy. It sneaks up on you and it gets rolling. And so that's why we look at so many statistics about inflation.